Here's something that's baffling Wall Street veterans and everyday investors alike. Stock prices continue their relentless climb upward, even as nearly every economic indicator screams that trouble is brewing beneath the surface. Let's break down this puzzling contradiction that has financial experts scratching their heads. Joblessness rates are climbing steadily, and if you think that's just a number on a chart, think again. Worker pessimism has reached levels we haven't witnessed in years, meaning real people are genuinely worried about their financial futures and job security. When employees start losing confidence in their ability to find or keep work, that's typically a red flag for the broader economy. But here's where it gets controversial. Despite these warning signs, investors seem to be living in a completely different reality. Inflation is making an unwelcome comeback, quietly eroding the purchasing power of American families. This means your grocery bill, gas tank, and monthly expenses are costing more, leaving less money in your pocket for discretionary spending. For beginners wondering why this matters for stocks, here's the simple truth. When people have less spending money, companies typically see lower profits, which should theoretically push stock prices down. Meanwhile, the United States deficit continues its dangerous upward trajectory, essentially meaning our government is spending far more money than it's taking in through taxes and other revenue. Think of it like maxing out multiple credit cards with no clear plan to pay them back. Most financial experts agree this creates long-term economic instability. Consumer sentiment, which measures how optimistic or pessimistic people feel about their financial situation and the economy's direction, has taken a notable dive. When consumers lose confidence, they typically cut back on spending, which creates a ripple effect throughout the entire economic system. And this is the part most people miss. We're operating in an environment of massive uncertainty regarding two critical factors that could reshape the entire economic landscape. President Donald Trump's tariff policies remain in flux, with businesses unable to predict how international trade costs might affect their bottom lines. Simultaneously, the Federal Reserve's interest rate decisions hang in the balance, creating anxiety about borrowing costs and investment strategies. So here's the million-dollar question that's dividing financial analysts. How can stock markets continue their upward march when virtually every fundamental economic indicator suggests we should be bracing for a downturn? Are investors seeing something the rest of us are missing? Or are we witnessing one of the most dangerous disconnects between market performance and economic reality in recent history? What's your take on this apparent contradiction? Do you think savvy investors have identified opportunities that aren't obvious to the general public? Or are we potentially watching a market bubble inflate before our eyes? Share your thoughts, and let's debate whether this stock market rally makes any logical sense given our current economic headwinds.